Welcome to Retire Well TV. My name is Cynthia DeFazio, joined today by Sean Odrabanak and Peter Samenuk of Citizen Advisory Group. And to our viewers at home, I am filling in for Kristen Oakley today. She is not feeling well. She's under the weather, so we are praying for a quick recovery. I know you miss her at home. I miss her too, but I'm honored to be here with you today in her place. Sean, how are you today?
I am doing fantastic, and I'm looking forward to this show and working with you.
Thank you. I'm honored to be here. And Pete, how are you?
Doing well myself, really. It is always great to be here. We look forward to these weeks that we get to film and talk about topics and things. We do appreciate you filling in for Kristen.
Of course.
But as the saying goes, the show goes on, right?
Yes, and I've had experiences where I've been under the weather and she has stepped in for me, so it times in just beautifully, if you will.
Yeah, we appreciate it.
So talking about timing in, if we could, we're talking a little bit about decreasing interest rates right now, and that's a good thing, right? We're going to talk about how it impacts your retirement so you can get a true understanding of what that looks like. And I think that this topic is so very interesting because when you think about rising interest rates, obviously everything that rises must go down as well. When we're speaking about interest rates, when it ties into retirement planning, what should folks be thinking about? Sean?
Well, that's a broad question, right? So we have experienced and we are starting to experience a declining interest rate environment. And how that translates into your retirement from our perspective is, where's the income coming from, right? So we're going to start to see the bank accounts, your CDs, your money markets, your savings account, your checking, all those are going to start to decline, right? And so if you're generating some income or getting some interest off of there, a year, 2 years ago, pretty powerful return for a pretty safe investment. But, now those numbers are coming down. So what does that actually mean for your income? So we gotta look at that, and we gotta maybe rebalance and readdress some of those products that we're in and how we were using them in our plan from last year and the year before that.
Okay, so make some adjustments.
Cynthia, I think you said, and I'll expand on it, you said, well, declining interest rates, and that can be a good thing. Well, it can be a good thing. I mean, it really just depends on kind of where we're at in our retirement planning, our financial planning, and what our mix of investments is, and really what the overall goal is. We've talked about interest rates quite a bit on this show, but that's because if we go back to, I'm entering my 16th year in this industry, and I have never been in an interest rate environment. Most people haven't lived through an interest rate environment like what we're doing right now. So it's gone through, COVID, and then they went up very quickly. And like you said, they kind of peaked for a little bit. But now everything that goes up must come down. And we're really right now, why we're talking about this again, is because now we're in that declining interest rate environment. And the projection for us would be, and I think most people in general, that interest rates are going to continue to decline. So we need to know, what do we do about that? What's that mean to us?
What does it mean to us? And so what types of products specifically are we talking about right now? Pete, if I could put that on you, would that be like savings accounts?
Yeah, that would be one of them, right? So it really affects everything in the financial services world and financial products world. And we're going to talk a little bit about that later in today's show. But specifically interest rates when we're talking about investments, and I'll just go back to the basics. Most clients, they don't really know what interest rates mean to them. I think most people think, oh, interest rates bad. Interest rates are up, that's bad. Well, that's typically bad for people that are looking to maybe get a new house, right? I think it's gonna be tough for a lot of college-age kids and younger adults entering the workforce and the real world, if I might say.
Absolutely.
Right now, it's gonna be difficult for them. High interest rate environment is not good, but it is great for retirees, right? People that are approaching retirement, in retirement. So it's affecting things like our savings accounts, our money markets. If we like annuities or guaranteed income or fixed annuities, those are the types of things, our CDs, right? Some of our clients are CD investors.
Of course.
So those are the things that we're talking about when we have good interest rates and they're starting to come down. We have to find out, is this the perfect window that we can kind of refinance and make sure that we're properly allocated there.
Properly allocated. Pete, thank you so much. Speaking of that, I have to ask you, Sean, what about the 60-40 bonds and fixed, if you will, when we're talking about even just exposure for your portfolio? How do interest rates affect that?
Yeah, Pete's speaking to the principal protected positions, right? Your CDs, your money markets, what's at the bank, maybe an insurance product, but there's, the 60-40 portfolio that also has that 40% potentially, depending on what your risk profile is, that it's going to produce a certain type of yield, right? And that could be some government-backed positions, right? Your treasuries. It could be some municipal bonds, some corporate bonds. All of these are also going to have an effect in the declining interest rate environment, right?
Okay.
And if you're not getting your income from, the bank products or an insurance product, your 60-40 portfolio, that's generating your income. Well, if that's what's generating your income and that goes down, that means you're going to have a little bit less income.
Sure.
So we got to go back to the portfolio and we got to rebalance it, or we got to live in that lifestyle with a reduced income. And I don't think too many people really want that to happen in retirement.
No, you want
right?
to enjoy and thrive. You don't want to go down and have to budget too much. Absolutely.
Yes.
Great point. Well, Pete, let me ask you a question when we're talking about just credit cards even. What happens now with credit cards and even pension plans?
Yeah, and so, right, it affects things like our home equity lines of credit, our credit cards, what you mentioned, pension plans, right? Interest rates have a profound effect on all of those things.
Okay.
As interest rates go up, if we're leveraged a little bit too much with debt, or we're looking to refinance or something like that, high interest rate is not good for us, But it can be attractive to kind of look at, again, refinancing some of our debt if we're a little more leveraged on those things as interest rates start to come down. So, pension plans. I have people, I'll just give you a couple of real world examples. People look at their pensions and they have this lump sum payment. And it says, hey, I've got $300,000 in this pension and I can take that as a lump sum, or I can take that as a monthly payment for the rest of my life. As long as I'm alive, I'm going to continue to get that payment. And people will be like, man, that lump sum actually came down. I lost money in this investment. Well, no, you didn't. Actually, what's happening in that is because interest rates are going up, that lump sum is actually going down because it takes less lump sum to generate the same amount of income. Now, the adverse effect of that is when we're having lower interest rates, that lump sum does go up, the value, because you need more money to generate the same amount of income that was promised to you, essentially guaranteed to you through that pension plan.
Okay.
So it just has an effect. I know we're kind of talking specific here and a little bit more detailed than maybe we want to, but it just has an effect on everything, and we kind of have to understand what interest rates mean to us individually in our individual situation.
Most definitely, because it's going to affect everyone differently. And I'm seeing a teeter-totter in my mind when you were explaining that. Sean, I want to ask you before we take our commercial break, how does this impact investments overall when we have a decreasing interest rate environment?
Yeah, historically, they're not a direct correlation, first of all, but typically a lower interest rate environment is going to yield or at least have a positive effect on the stock market. Now, we're going to talk a little bit more details later about that, but most of the time, you're going to see that, maybe that bond portfolio isn't getting you the return that you desire. So then it's like, well, if I don't want that return, or if it goes to 3 or 2%, I almost have to shift to an equity position for a return, right? So now my inflation hedge is my equity exposure. And that gets a little challenging, especially if you have some market averse clients. So you got to get real creative in how we can manage to get a return predicated around risk tolerance, right? So now again, this doesn't always, there's not a one-to-one correlation, because if you think of 2022, the stock market went down and the safe part of your investment portfolio also decreased. And people were sitting there saying, wait a minute, this is supposed to be my safe part of my retirement. And it's not. What happened, right? So we've had a couple clients come over from that, and I think the goal of today is education.
Absolutely.
It's understanding, what does this actual time mean to you and to your portfolio and ultimately your income in retirement.
Absolutely, absolutely. On that note, Pete, I know that you and Sean have a very special offer to our viewers at home. Let's talk about what that is before we take our first commercial break.
So for any callers today, and I'm going to let kind of Cynthia do her part about scanning the QR code, but what we're really offering is, number one, a complimentary appointment. We'd like to have you come in, meet with us. And what we're gonna be doing in that is producing a written financial income plan. And really, that's the very most important thing in our firm, is having that written income plan. And that's very directly tied to interest rates and a changing interest rate environment, because it's gonna allow you to see where am I getting my income from? Is my income sustainable? And maybe if we're a little bit too heavy in the market, or maybe we have some products that could be changed around, to generate our income for the rest of our lives, that written income plan is going to show us the gaps and kind of where we're missing the boat to kind of have those things. So for our callers today, we are offering that written income plan. And that's a very important piece of our financial planning process.
Pete, thank you so much. And Sean, thank you so much. To our viewers at home, the number to call is 866-630-1675, or even simpler still, you can click on the QR code at the bottom corner of your screen. That'll take you right to the landing page, of course, of Citizen Advisory Group, and you can book your complimentary consultation today, where you will also receive your written income plan. You need to have a written income plan for your retirement years. It's so paramount, especially when we're talking about things like a decreasing interest rate environment. How does that impact you overall? Once again, the QR code is at the bottom corner of your screen. Please grab your smartphone and click on that. We'll be right back momentarily on Retire Well TV as we talk about more involved with interest rates decreasing and how does that affect your investments in your portfolio. Stay tuned.
The keys to a successful financial plan are, number one, we have to understand what is somebody trying to do. Having a financial plan is like anything else in life. We have to have a plan for it. If we have a poor healthcare diagnosis, we have to have a plan for it, right? Our doctor sets us out. This is our treatment plan. We know what we're going to do a month from now, 3 months, 6 months, 5 to 10 years in the future. If you're planning a trip, right? I've had some clients do some pretty crazy things. I had a woman recently who had a van and it was just her, and she drove all the way from Northwest Ohio here in Toledo, all the way up to Alaska. And she had a plan. She knew how much water she had to pack. She knew how much food. She knew that she needed tires and things like that, just in case things went wrong. And it's very similar in financial planning. And it all starts with building a plan, sitting down, having a casual conversation, and just saying, what does having the right plan look like for me working with a family-owned independent advisor?
Let me ask you something. If something happened to you tomorrow, would your family know what to do? Would they know where your documents are? Who to call? What your wishes are? I've worked with a lot of families, and I've seen what happens when clarity is missing. It's not the money that causes pain, it's the guessing. That's why we put together something called the Legacy Quiz. It covers the key areas most families overlook, from wills and powers of attorney to digital accounts and where important documents are stored. It's quick, free, and surprisingly eye-opening. You can take the quiz now at caglegacyquiz.com, or just scan the QR code on your screen. It's a small step that can help your family avoid some very big problems.
Welcome back to Retire Well TV. My name is Cynthia DeFazio, filling in for Kristen Oakley today, and I am joined by Sean Odrabanek and Peter Samenuk of Citizen Advisory Group, and we're talking about what happens when interest rates start to decrease. How does that affect your overall retirement plan? Thank you for being with us today. So, Pete, I want to ask you, obviously, we talked so much about just how it affects everything, your CDs, your savings, what have you. When we're talking more specifically about the stock market, how do lower interest rates impact the stock market?
Yeah, and we wanted to jump back into this show to just be redundant because of the timeliness of it. We feel that there is a window that we are running into right now that, the goal of the government with inflation and everything is to start to get interest rates down. So we kind of saw those things peak, and now we're on the way down, and we just wanted to make sure that we're being timely with the information and saying, what do we do now that interest rates are starting to come down? So specifically on stocks, Sean hit on this a little bit earlier, and I think it was great what he said, is that it's not a direct correlation, right? So we can't just say one for one. In theory, I will tell you, as interest rates start to come down, that's typically supposed to be better for stock prices. We're supposed to have inflated stock prices because our risk-free rates of return are less. We can get less return in some of the safe investments, our CDs, our money markets, our annuities, some of the things we talked about. So typically what investors will do is make a flee over to the market to get a appropriate return for what they're looking to do. So in theory, as rates start to come down, stocks should be rising. So, we just kind of need to be aware of that direct correlation, and that's where just looking at and having a review and making sure that we're properly allocated is going to kind of make sure we're taking advantage of that.
It's so important to have that review, especially with the topography changing so often when you're planning for retirement. I mean, you have to be aware of all these changes. So Sean, I want to ask you a question. Obviously, the relationship between interest rates and stock market performance, it isn't always predictable. What else can influence performance?
Oh, I think to open the show, right, there's a lot of different factors, right? So even like company fundamentals and the technical analysis of the company, or geopolitical, landscape changes or shifts, right? So there's a lot of things that are going to impact an actual company. And I think to Pete's point, that's where we kind of come in, and we do that research to say, how do you build a well-diversified portfolio to hedge against all of these? So if we do have to go to the stock market for a return, well, how do we best get that access, right? And most of the time, in my experience, people come to our firm, they watch the show, they scan the QR code, they come in, and it's like, you said some things in the show that it brought some awareness to me and to my situation. What did you mean by that? And then we really take the time to educate and understand, hey, this particular portion of your portfolio, you want to have different from this particular portion. And most people think that they're still in an accumulation mindset of, I need to grow, grow, grow. And I'm with you to a degree. We want to see growth. We want to see your accounts grow. But I also want you to think, how do I use this growth, this past 25 to 30 years of growth, and take a portion of it and shift it to, now this portion's going to derive me money, right? Most people come to the firm and their net worth is far more important to them than it is to me, because what I'm actually shooting for is I want you to have net freedom. I want you to create an income to where you are free to do the things that you want to do when you want to do them. And, right now, to Pete's point, there's a decline in the interest rate environment. And if your income is coming from those products that we've discussed in the past here, well, we might have to take advantage of what's going on, and maybe we got to do a rebalance and shift out of these products and see where can we actually get an actuarial edge to maybe shift out of that portion and go to another product or another area. But that's the ongoing management that we offer through the written income plan.
Absolutely, and it's so important to have active versus passive management when it comes to retirement planning. Pete, I want to ask you a question. When you're thinking about it, why is diversification even more important than when interest rates are low, if you will?
Yeah, so Sean made a lot of good points there, and really the most important thing to me, and what I'm going to talk about right now is, we have our diversification in our portfolios, right? We've got our stock market portfolio where we've got a mix of 60% stock or 40% bond or 70% stock or 30% bond or whatever that mix for you is. But what diversification to us at the firm means diversification in strategy as well, right? Diversification in the products that we have and diversification in the different buckets of money that we have. So it's not just diversification in a portfolio, but it's diversification amongst the types of strategies we're using, like Sean said, to generate our income. Do we have enough income generating things? And not just diversification to where we're trying to grow our stock market. I'll go back to in my career, I have never seen a better window where we're sitting at all-time stock market highs and interest rates are now still very strong. And we all get a little bit greedy too. I won't lie. I'm a victim of this. I'm not calling anybody greedy, but we look at money markets and CDs, and I had a couple of clients this past month, and they're like, oh my gosh, this money market's only paying 3.9%. Well, 3.9%, if I could get that 5 years ago, I would have had everybody making a run to the bank and trying to get that 3.9%. But now we're all thinking, oh, this used to pay 5% or 5.2%, and we get a little bit drunk on kind of the current thing. And that's why it's so important to stay current and why we're talking about what are we doing as those interest rates start to decline to make sure that we're taking advantage of it.
Pete, thank you so much. Son, thank you so much. To our viewers at home, the number to call is on your screen, and it's 866-630-1675. If you're curious how to manage your retirement plan right now with decreasing interest rates, how it impacts your future overall, book the consultation today. Once again, it's 866-630-1675. Completely complimentary. We've made it even simpler. You can grab your smartphone, click on the QR code at the bottom corner of your screen. That'll take you right to the landing page of Citizen Advisory Group, and you can schedule your appointment accordingly by using that little QR code. Once again, this is for the complimentary retirement income plan so that you can have peace of mind in your future. When we come back, we're going to talk a little bit about how does this impact your overall withdrawal strategy during times like this. Stay tuned. We'll be right back on Retire Well TV.
So for most clients that come to our firm, I think they share a lot of common fears.
They really ultimately want to know if they can retire. And they may be working with an advisor and they still have that question, right? Can I retire? And I ask them, I go, what does your current advisor say? And I get a unanimous answer. It's, well, just retire and we'll figure it out.
But what we have built differently is just more of a team approach to where there's multiple advisors, there's multiple support staff that allows us to take our shared knowledge and expertise across these different areas of retirement planning, but then bring them together so that we're delivering cohesive financial solutions to our clients that aren't disjointed, which is what we typically see in the general retirement landscape or financial landscape.
Welcome back to Retire Well TV. My name is Cynthia DeFazio, joined today by Sean Odrabanek and Peter Samenuk of Citizen Advisory Group. And we're talking all about what happens when interest rates are decreasing. How does this affect your overall retirement plan? And most specifically in this segment, what about your withdrawal strategies? Something to really pay attention to. So Sean, I want to ask you, should retirees consider like rebalancing or redoing their withdrawal strategies when interest rates drop? Is there going to be a change for them is what I'm trying to ask you on the horizon.
Yeah, I would say depending on which strategy you're using, it's likely that there is going to be a change, right? So we're going to get a little nerdy here for a minute. So if I bore you, just wake up in 4 minutes. But
Too late,
you know,
right?
thanks, Pete.
I love it. It's going to be great.
We've already
We love it. We love it.
But you know, there's a couple different approaches to income planning in retirement. So we can do something called a flooring strategy, or we can do a bucketing strategy, or what Cynthia said, we can do a withdrawal strategy. And sometimes those strategies kind of, the client doesn't quite understand, and why should you? You're not a financial planner, right? But we try to look at this and say, depending on how you're getting your income, and we have experienced this interest rate decline, your income might go down, right?
Okay.
If we're using 2 or 3 of these, and we don't want to get too complex, but the goal is to make this very complicated plan clear, right? I've said it before, I'll say it again. The goal is to educate you on, you know exactly what this account is doing and why it's doing it. And if that account is your income bucket and our portfolio now is going to decrease, well, that means your income is going to be a little bit less.
Absolutely.
So maybe we switch it and we say, you know what, let's get out of that income, you know, that bucketing strategy, and let's go create an income floor.
Okay.
What's the least amount of money that you need every month to live happily comfortable? What is that number? Do you know that number? We kind of help you find that number, and that might be an opportunity to change, because while interest rates are coming down, to Pete's point earlier, they're still pretty good, right?
Yeah.
They're
Yeah,
still
absolutely.
pretty good from 2019.
Of course.
Right? We're happy with a 3.5 or a 4% principal protected safe return.
Sure.
Right? So we have to come in, we have to evaluate it, we have to rebalance it, and because that's the only way that we're really going to know.
Absolutely. Makes perfect sense.
And going back to kind of, I'll expand on like the bucketing strategy
Yes.
you're talking about, a couple of different things. You know, we're all somewhat familiar with like a 4% distribution rule,
Yes.
where, you know, you have X amount of dollars when you retire at 65. And if you take 4% per year adjusted for inflation, you should have enough money to last you through retirement for 25 to 30 years. With the key point being there, the key word is should. You know, and the problem with the 4% rule, I actually won't argue or dispute that the 4% rule works, because, you know, it does in a lot of instances, but it's mismanaged. You know, people are taking too much risk when utilizing the 4% rule. Because why? Because they have the same funds or the same investments that they had when they were 30 that they now do when they're 60 or 65.
Okay.
So if you haven't done, again, that fundamental rebalance we're talking about, the same investments and strategies that got you to 60 and 65 are not the same ones that are going to get you through retirement and get you all the way until the finish line, whenever that might be. So that's what I think the 4% rule, again, works, but we have to be focused on, reducing risk and kind of utilizing some of these guaranteed income strategies that Sean was talking about. That will be like the income floor, and just making sure that our baseline income is there for no matter how long we're going to live.
Sure.
Yeah, that's a good point too, because that particular study was a 60-40 portfolio.
Right.
And if you don't have a 60-40 portfolio and you're taking that 4% rule, that 4% may not equate or may not be as safe as we think.
Yeah.
And what I find fascinating is a Morningstar just published that the new safe withdrawal, because that's what this 4% rule actually is, the early data suggests that it's more like a 3.74.
Yeah.
Wow,
Right?
so
it's
it's
the
changed.
first time in 100 years that the 4% rule is being challenged. Now, we won't know that until 2030 or so, but for the first time, the data suggests that the 4% is being challenged.
Wow. So a lot of people follow that, and that should be changing. Absolutely. Now, Pete, we only have a minute and a half left of the show, but I want to ask you quickly before I go to Sean for the close, what inflation concerns should retirees be thinking about in a lower interest rate environment?
Yeah, and so it is a loaded question, and all of these things are so directly correlated, because the reason we have higher interest rates is because inflation is higher,
Yeah.
right? And that's kind of what the government does, or the Federal Reserve does, to combat inflation. They increase interest rates, and typically that's supposed to kind of tighten the money supply and kind of increase purchasing power. But it just means going back to like having balance in a plan, and me going back to I've never really seen a better window, and that's getting more narrow and narrow every single day as interest rates continue to decline, is that we have enough money in our inflation bucket for the long-term stuff, but we have enough money for the now and the short-term needs that we have.
Sean, your final words before we close.
So with everything that we talked about today, from what product you're in to the timing that we have, you got to take action, right? You have to come in, you got to scan the QR code, you got to call the number, because we would love to help you. I know that the team at Citizen Advisory Group would love to help you. And what that means is that we actually might be able to get you a little bit more income in this interest rate decline. And if that a little bit more income is good, a little bit more income is good, so you might have a little bit more to spend.
Sean, thank you so much. Pete, thank you. To our viewers at home, thank you for joining us today on Retire Well TV. Be safe, be happy, and be blessed.